Welcome to the Broken Pie Chart Podcast, episode 351. I'm your host, Derek Moore. Back with me, of course, is Mike Snyder and Shane Skinner. All right, Shane, I'll start with you. You kind of said this is a weird day. Why do you think it's a weird day?
It's odd. Oil shot up pretty aggressively this morning, right? Usually when there are big moves in oil, that can sometimes be associated with weird moves in the indexes and stuff. We also opened down quite a bit, and essentially rallied over 100 points in the S&P in a matter of the first 2 hours of the day. But VIX held over 20. It's an interesting situation. I wonder if, going back to what you've brought up in the past, Derek, with the Supreme Court thing, I wonder if the market's starting to get a little concerned about them overturning it, just not knowing sort of what to expect. It also seems like the rate cut in December that everybody was so adamant we would get might be off the table. So we'll see.
I mean, I would say that whether they cut a quarter point, don't cut a quarter point, it's somewhat insignificant in comparison to earnings. On the Supreme Court thing, for the audience who may not tune in each and every week, what we've been saying is they heard arguments, and that case has already been argued in front of the Supreme Court on whether President Trump can actually enact the tariffs under this one statute. I think it's the IEE. Now I'm forgetting the acronym. And I don't know. I don't think it is. I don't think the market cares about that. I think the market's done with tariffs, and they could refile them under any number of other statutes. So I'm not sure that's it. Honestly, though, I mean, we had the Michael Burry stuff where he tweets out that, these companies are doing what? They're increasing or lowering their depreciation. So for everyone, here's for the home gamers, grab a pen and paper. You buy a server, you buy a widget, whatever it is, and the idea it has a useful life. And so you depreciate the asset over its useful life. And what Michael Burry is saying, and apparently he said this on Twitter, is a lot of the big hyperscalers, Mag 7s, are extending the useful life of some of the servers. And when you do that, so your net income increases, because depreciation is it's a non-cash charge, but the more depreciation, the less net income. Now, it doesn't affect free cash flow. And so that's one of the things. And when you look at that, and we've been talking a lot this week internally. So we went ahead and we looked at the growth in free cash flow versus the growth in net income across Google, Amazon, Nvidia, some of the, Meta. And there was, the growth is not as robust in free cash flow because they're spending CapEx. But they are, obviously growing their net income. Apple was the one really that wasn't affected. So I don't know, we'll get into that a little bit. But Mike, I mean, you and I were talking, I think yesterday, and I was like, who's right, who's wrong? Apple and high yield are holding up. And Apple and high yield held up this morning when everything else was down. I guess they were right. The market was wrong.
That's the way today turned out. I mean, we opened down, and I'm thinking we may actually get some follow through from a down day before, which it just seems like every down day has been, followed by a buying opportunity that reverses the previous day's losses. And this morning it looked like there's actually going to be some follow through on this sell off, and before you know it, Shane and I were talking mid morning, and the market had almost gotten back to break even. So it looks like Apple, which is held up, on down days, it's been flat, maybe even slightly higher, and yield were right today.
I'm just looking at, and I had taken some screenshots of some charts looking at the growth in free cash flow versus. So let me explain what I'm talking about here. Free cash flow, and I'm going to explain this really easy. It's kind of like, imagine you own a coffee shop and you have all these expenses. Some of them are non-cash expenses. Some of them are. There's accounting things. You have accounts receivable, accounts payable, all that stuff. But you start the year January 1st with a certain amount of cash in your register. Imagine you're not taking money out, taking money in. It's everything. It's actually cash going in and out of the business. And then you look at the end of the year and you count the cash. And if you have more, you theoretically have more free cash flow, is what they call it. I'm dumbing it down. It's a super easy explanation. But it's this idea that Michael Burry, I think, and somebody passed me the tweet or told me what it was, but he's basically saying that these companies are juicing their net income because when you extend, and he's like, there's no way, I don't know, this widget server, whatever the heck he was talking about, is going to last this long. You're going to have to replace it beforehand, and therefore your depreciation charged to your net income should be higher each year. I mean, Shane, we looked at these and like Apple and Nvidia, the lines were going kind of in the same direction on free cash flow and just the dollars, right? The dollars of free cash flow and then the dollars of net income, not the income per share, earnings per share. So I don't know, is he onto something? But he also tweeted out sell and the market's up like what, 40% from when he did that. So who knows what he knows?
I think I mean really notionally it's much bigger, but I think it was only like a $9.6 million position he put on. I say only $9.6 million. Like that's such a small sum of
Yeah, you got
money.
that late. You got that in your couch cushions,
Yeah,
Shane. I
that's
know.
literally under my
Yeah.
mattress.
Mm-hmm.
Uh, the one thing that's odd to me though that I'm just
Oh, we got a special commentator coming in. I heard that.
Let's get his thoughts on the market.
Well, I mean, honestly,
He is
Michael
very
Burry.
entertained.
he and Michael might not be too far off from one another. I apologize. Thank you guys. No, it's Burry's also notorious for being early on some stuff. You know, I think he had a short and back in 2022 he did all right, but there've been countless times before where he's predicted 7 of the last 3 crashes, right? If you will. So I don't know. We'll see how it plays out. This market's also been a lot more resilient than any other market I think he's seen, and I think he followed up saying at the end of this year he's closing his hedge fund. So he chalked that up to not understanding the way stock prices and these certain names are behaving.
I mean, look, he obviously was right on housing. Like you said, he was early. If you want to watch The Big Short or read Michael, what is his name? The author who wrote The Big Short, Michael Lewis, right? So you can read those. You can watch The Big Short. I think it's pretty entertaining. It's not my recommendation for this week, but yeah, I mean, it's sometimes people get something really right. And look, I don't know his investment returns. I don't know. All I know is what I read about him from kind of the Big Short era when he was buying credit default swaps on some of the mortgage bonds, betting against the bonds. It takes me back though. Sometimes these people get one thing really right, and that's the thing they get right. Like you guys weren't on the podcast when I had Nick Maggiulli on, who wrote the Wealth Ladder. He has this whole chapter is like, what got you there won't get you here. Meaning, just because you acquired wealth one way doesn't mean you'll be able to do it another way. I don't know. I don't want this podcast to be all about Michael Burry, but it's obviously entertaining to watch. Mike, if you look though, the VIX today, did we close? We closed above 20, right?
We did.
Yeah.
Right below 20, actually, 1993.
All right. So it just came in a little bit lower towards the end of the day. I mean, would it surprise you if we just kind of stay within all time highs, but stay within the 20 handle on VIX? Like everyone's worried. I think sentiment's kind of it's worried right now.
Yeah, the market definitely seems a little shaky, but it hasn't given any ground. At least the broader market really, is flat for the week. So I think we could continue to see these types of sideways movements, but bigger intraday swings, which is going to keep the VIX up. I think that's definitely a possibility here, especially I would think leading. I think Nvidia earnings are still going to be really important. Um, it feels like the sentiment around those stocks has changed in the last week. There's more concern about, the spending in terms of AI. So I do think Nvidia earnings are still going to be huge and have an impact on the broader market.
I'm trying to think the last time, Nvidia always feels like it's the most important earnings ever. It's the most important earnings ever for that company and for the market. And I got to be honest with you, thinking back, I don't know that it moved the market that much. And I don't know that it moved Nvidia that much the last couple times. I think if they missed or they guided lower, that would be a surprise. But if you look at the capex spending, it's going somewhere. I think it's going to Nvidia, and whether that's priced in or not. Look, if you want to buy Nvidia, buy it. If you want to short it, remember you have unlimited loss to the upside. I'll let everyone decide that. But I mean, Mike, do you think it's going to be a little bit of a letdown? Like everyone's expecting it.
Yeah, I think by important, I mean they just can't miss significantly, right? I think that would have a huge impact. If you look at their last earnings in August, the stock it's a little bit higher than there, but it's it traded pretty much sideways. They had a run up, and now it's back to where those levels were right around earnings. So if everything continues as they have been, I think that's positive, and maybe the market takes a big sigh of relief. I think it's just important that they don't change their guidance significantly or miss significantly or say something unexpected on this call. I don't see a ton of upside coming from the earnings. I think there's more risk in something negative coming out.
Shane, since Mike's talking about Nvidia, let's just go ahead and look at what the expectation is as far as volatility. And I'm seeing the 190 strike, which is right sort of at the money, give or take, just under 70% implied volatility. And for the audience to put that into perspective, that is basically, for a 1 day move, if you have a 70, you divide that by 15.875, which is the square root of 252. And a one standard deviation range is like 4.4%. Now when is the 19th? Oh, these are next week. So it's kind of like a week. So you got to take the square root of 5. Yeah, square root of 5 times, what did I just say? 4.4. So it's like 2.2 times 4.4. I'm doing this live here. So between now and this time next Friday, I mean, it's kind of pricing in around 9 to 10% one standard deviation move, in whatever direction that is. I don't know, Shane, do you think it's properly pricing in the volatility? I mean, 68, 69, 70, it's not low, but it's not like super high like in some of these companies that report, right?
I mean, I'll tell you in a week, obviously, but
Yes, let us
it's
know.
odd. Okay. On one hand, it surprises me because, like we've said before, I think it's been pretty common to see 5 to 10% moves on a one standard deviation basis being priced into a lot of these high flyers and big names. I almost wonder if it's so big now that, not that it's not capable of moving that much, but it just, like, I think everybody sort of knows what Nvidia is, what it's doing. I think expectations are really clear. Analysts' forecasts on Nvidia over the past few quarters have been pretty spot on. So I almost wonder if people feel like they have a really good idea about this stock, what it's going to do, what the numbers are going to look like. And with that comes more certainty and a less expected move. But at the same time, with any given name, I'm sure you know this, Mike knows this, like anytime you're as big of a company as Nvidia, doesn't mean you're invincible. It doesn't mean that you can't pull back or make larger than one standard deviation moves. And, obviously there's significant risk to the broader market if something like that were to occur, to the downside at least. But, you know, I think the surprise would be to the upside here. If they have a really good earnings and they rally, it could be exactly what the market's looking for going into the end of the year.
You know, the I think with Nvidia, and by the way, the straddle. So if you wanted to buy the 190 call, buy the 190 put because you were thinking, hey, it's going to go really far one way or another. Cost you about $14.50 roughly. So just round it up to 15 for easy math. That puts you at 205. You break even on the upside, and what is that? 15 to the down.
175 to the downside, which
Yeah.
is pretty,
So
pretty reasonable. Like, we've been around those spots before. There seems to be general support resistance there. I think that makes sense.
yeah, and you could sell that if you think it's going to be within the range because implied volatility is up. You could buy it, and there's 16 different ways and more to lose money on this trade in either direction. Like you really got to move here, and it's always interesting right before earnings. Sometimes we price it, and you say, well, I should have sold it or I should have bought it because sometimes it exceeds what the options market is expecting on a volatility basis. But yeah, I mean, it should be interesting, and of course the call. This also leads to. Can I tell you guys, Mike? I don't know if you've talked to anybody recently who's asked you about ChatGPT's IPO. So I had two different people this week, and I think another one the prior week, who asked me how to get in on ChatGPT's IPO. And for anyone who doesn't know how this process works, I'm not going to explain over. It took me a long time, but basically, investment banks, they work with a company who wants to come public, and they would figure out the size of the offering. They would value the company, and then there's some things where how many shares are the insiders selling, whose shares are they, all this stuff. And then there's a kind of the lead investment bank normally, and then you have a selling syndicate. And after I said all that, I'll repeat whatever somebody told me years ago, back in probably the mid 90s. Like if you're a retail person and you can get your hands on an IPO, you may not want it. It's a general statement, but a lot of times the really hot IPOs, the ones that are priced at 20 and then come out at 50, like you're not getting that one. It's not happening. But the idea, Mike, that there is a company that's not public yet that people are starting to talk about. I don't know. I mean, I don't even think it's relevant to the market really. Do you? I mean, what do you think about that?
Yeah, I mean, that's interesting. I don't think it's relevant right now. Um, yeah, I mean, I think it will add some more color to how these AI companies are spending, just because there's going to be another player. It'll be interesting to see the volatility in the name if it does come public, but I can't see the market trading higher because there's going to be another company that goes public. That being said, this would be, you know, one of the biggest IPOs in recent history. I would think. I feel like there hasn't been a ton of really big IPOs recently. A lot of companies have been staying private. So
The part about this company too is it reminds me of, so there's these technical revolutions that happen, and this is from Carlotta Perez's book, Technological Revolutions in Financial Capital. But it's this idea of you have these new sea changes or these massive moments in technology. And it could be the steam engine, it could be any number of things. It was the internet that started in the late 70s, and now we have AI. And I think AI is, I could be wrong on this, but I think it's one of those. But just because, like, how many times have we seen someone comes in and builds a restaurant and they spend a ton of money designing the restaurant, doing the architecture, gorgeous restaurant, awesome place, and they wind up going bankrupt. And the person who comes in after and just buys it at a discount with everything already done it's like the second owner that makes money. And I bring that up because like I don't know. I mean, they're not a public company. You can't see their financials, and you just sort of know what you see and read and hear, right? But I do wonder if the technology could work. This could be an innovation, and it could be accretive, or it could be a big productivity gainer in the markets. It could benefit all the existing companies. It doesn't mean that ChatGPT or Anthropic or any of these companies are going to be the one. Like, there's a scenario where they spend so much money building this out, and the technology's there, and maybe they're not the ones. Maybe somebody else picks it up at a discount. I don't know, Shane. It's just I've had that thought recently, and I don't know. I mean, we have no idea. I mean, this company's not public, so
I mean, I think it goes back to our conversation we were having prior in the chat, and earlier this week, talking about equity to free cash flow, equity to net income, the
mhm.
depreciation stuff, and realistically, like Apple hasn't been spending a lot of money. It seems like they've been hoarding more of it, right? They haven't done a ton of capex on AI. And Apple, I'm not saying Apple's the one either, but look, Apple's notorious for not necessarily being the first to the table. Um, so I'm still waiting to see what they do and where they go with it because I know they're going to do something. There's no way they're not involved in AI down the road more than they already are.
But they could
But
just be users, and they could benefit
exactly.
from
Exactly.
now.
And
There's this
where
technology that they didn't pay to create.
right. And where it would make sense for Apple to make a large investment in an AI is exactly what you just said. If one of these brilliant firms with very useful tools and systems and tech just doesn't quite make it and can be bought for pennies on the dollar or a fraction of what they were originally valued at, it might be worth it for Apple to do that. But I don't think we have any idea the just how like big the use case for AI will be eventually. And I think it's more so just a question now of is it going to start really popping up and return on people's investments into it as businesses? Are they going to start seeing margins get better because of the use of it sooner, or is it going to be a couple more years from now? And so it's kind of like, again, everybody goes back to 90s, 2000s, the internet. Everybody knew in the 90s and 2000s the internet was going to be it. Um, and at the same time, it still took a while for it to get where it's got. So,
I mean, when I go back and I look at the web browsers, so we had Netscape, Excite, Go. Google was actually later.
I don't think I used any of those. I might have used Netscape
Yeah, and
once.
then there's AOL. People used to have an
Okay.
AOL
Yep.
account.
Yep.
There
Instant Messenger.
was it Spider browser? There was Spider something. There was, I feel like Microsoft had one. Yeah, like Excite was. So think about, oh, Yahoo, obviously, but think about Yahoo. Excite was like a version of Yahoo where you went and you had a homepage was your news. You logged into your Excite email. They ran commercials and stuff. The point of bringing this up is like these are all people who, I mean, the cost to develop Netscape probably wasn't cheap. I don't know if they got sold, they went out of business, or somebody else just acquired them. I really don't remember. But all this money that's going into this technology, it doesn't mean that the people developing it are necessarily going to be the reap the rewards. Maybe they will, um, but we'll see. Can I tell you though, the this is the most somebody has asked me about an IPO. People not in our industry since I think it was early '90s. Do you guys remember Snapple, the iced tea? I mean, they're still around.
Yeah, absolutely. Yeah.
Okay,
They've got all the quotes and fun facts right under the lid.
I haven't had a Snapple in years, but Snapple in the early '90s, when that was going to go public, everyone was like, "This is going to be unbelievable! Like, this is going to be the biggest IPO ever." I think it came out. It definitely jumped. And I remember back then, everyone's like, "Oh, how do I get shares of it?" I'm like, "You're not getting shares. They're going to jump on day one. Like, that's not happening." So, and then They eventually, I think Dr. Pepper bought them.
Yep.
I'm looking it up right now. Okay, so Dr. Pepper. According to just Gemini or whatever, the AI overview on Google, they were part of two IPOs. So 92, and then as a broader Dr. Pepper Snapple group IPO in 2008. And now they're a private company under the ownership of Keurig Dr. Pepper. Okay, enough Snapple talk. But yeah, all right, we'll see. Anything else on this, Mike? Are we missing anything?
I don't think so. I mean, does when you start getting asked about an IPO a lot, does that sort of raise your antennas and give you pause?
I mean, it tells me that if if people think this is a can't miss, yes. Like if everyone wants this, maybe it is a contrarian indicator, you know? I mean, when a company comes public, they'll file the S1. That's what happened with WeWork. They filed their S1 and everyone's looking at the S1 saying, what is going on here? Like, are you serious? So, yeah, I think so, Mike. I mean, it's kind of like when somebody calls me out of the blue, and this was 2008. Remember, oil went to like $165 a barrel or something like that. It was after Katrina. And I had some people call me and say, "Hey, I need to get in on oil. Like, how do I buy oil futures?" I'm like, "You should not be trading oil futures. You know, you've never traded futures before." And that told me it was the top, you know? So maybe.
You know, it's funny. I think people forget, didn't they start as a nonprofit, Derek? So they've gone from a nonprofit to about to IPO.
Well, they're
I
not
think that's
about to
very,
IPO. I don't think,
or sorry, they might if they do.
maybe.
It's interesting to say the least. Here, if you want to continue to talk about this, please. I've got a little snippet I want to throw your way when we're ready to segue.
Let's segue. What do you got?
So this is according to M365 Copilot. I believe it's the Microsoft Edge Copilot AI.
Okay.
So recently, the White House Secretary Bessent said that they're going to do these accounts, right, for newborns, $1,000 invested into the market if you're born between January 1st, 2025, and I believe January 1st, 2029 is that time frame. And so I forecasted, okay, what's the expected, total number of births between now and then? Gave me between 14 and a half to 15 million roughly. So you take that times the $1,000 each one of those accounts is going to get, and that comes out to about 14 and a half to 15 billion dollars over the next 4 years. We're likely to see invested into the market. If you try to break it down on a monthly scale, it's about 300 million, give or take, monthly inflows into the S&P for newborns. So I find it interesting. I'm sure some people have opinions on it in either direction. But, if people leave that money in the market, those kids, hopefully the market's much higher between now and the time they're needing to use it. And it helps. We'll see.
I mean, these are all flows that can come into the market. And I don't think you're wrong. I think flows can help bolster the market. It can help put a floor under the market. It doesn't mean the markets aren't going to have
No,
bear markets or anything like that. But it's similar to, I mean, people forget, like even in, the early 90s, not everybody had a 401k like they do now, and not everyone was automatically enrolled. And more people are in companies or working for businesses or companies that are not pension based. I mean, it's more so in Europe that pensions are still around. But yeah, I mean, when I look, think about every 2 weeks, there's money coming into the
42%.
market.
42% roughly full-time workers, which is about 40.6 million. This is according to U.S. households lacking retirement access, SIPP 2024-2025. Same thing, Copilot. Yeah, about 40.6 million reported no access to employer-sponsored retirement plans. 44.1% don't participate.
This is this year.
Yes.
But
And
it used
then
to be much lower. Like if you don't do it now, but I'll bet you if you go and you look and how many people actually had a 401k back in early 80s, late 70s, like
oh, I
this
bet it's
matters.
significantly lower. Right.
It's the highest it's ever been in terms of
There you go.
the percentage of
Yep.
people having a 401k today.
And they
And
don't
yet,
sell. Mike, I mean, they
no,
don't sell, right? I mean, if you have a 401k, most workers, it just comes out, it goes wherever it goes. And they're not sitting there being like, oh, I don't know. I don't know. Could this be the top? I better sell. Like they just leave it, Mike, right?
Exactly. A lot of the 401k providers, it's not easy to sell. That's part of it. You have to go through steps to submit, you know, things to the provider to get them to sell. They don't really make it that easy, and people don't look at it as active trading. They don't even really, a lot of people don't even really look at it. They just have it auto invested and probably better off for it. Just to leave it in and let the market do what it's going to do.
So,
that's what I think people are so shocked about is how resilient this market is. These passive inflows, like you just said, people don't touch them. They're passively managed, and they're buying the same stuff every couple of weeks. Sorry,
so
Darren.
I did some quick math on this $1,000, right? So they get it on day one, let's say. So $1,000. Let's say they average what 9% a year over 65 years. I mean, probably 10. I mean, who knows, right? Going forward, I'll throw the caveat in there. But so if you do the quick math, 1,000 times 1.1, uh, raise it, do the exponent to what 67 full retirement age.
Yeah,
Okay, so that thousand turns into 593,348.
incredible.
It is incredible. It is absolutely incredible. And but it also
Would you argue this is almost better than Social Security? I don't want to upset anybody and get too political here, but like theoretically, if that works out, that's a better insurance plan for somebody down the road probably than the way Social Security pays out. I
well, I
mean,
mean, the thing with I did you can get the statement of everything you've ever paid into Social Security. And I went through this exercise once where I said, imagine instead of giving it to Social Security, and remember, there's the employee, what is it, the 7 point, almost 7.5, it's between the employer and the employee, you're actually what, 14
it's
and a
quite a bit.
half?
Yeah.
Yeah. So I said, what if I just took that and put it into the S&P every year? And I did the math and I was like, this is crazy. Like this would be way better. This would be way better. Like you would have a lump sum and everything. Now, it's a whole different discussion of, oh, are people better off with a lump sum? Then how could, could they draw it down over the life expectancy or this and that? Yeah, they'd be better off going into the market. Like the return you get on Social Security is not great. They tried. So during George W. Bush's first term, they tried to, I don't remember, it wasn't a full privatization, but they tried to do the Chilean model. And Chile did something where they privatized and they wanted to do it for workers under a certain age to just have money that goes into like, some mix of assets. Yeah, that'd be way better. Way better. You don't get a great return on Social Security. And, it's think about someone who retires at 67. Wouldn't they rather have a couple $1,000,000 in a lump sum that they can then use to secure their living space, to whatever? I know not everyone's going to be able to manage that. Not everyone, you could design some. And also, it's really tough when you have one system to go from that system to a new system or anyway. So, yeah, I don't care. You can ask me about that. And yeah, the numbers say you'd be better off just going into the market. Sorry. Mike, any thoughts?
Yeah, I mean, I think there's no question you'd be better off going into the market. It's a matter of, and like you said, different discussion, what that looks like once you get that lump sum. If you can touch it before retirement, or if it's completely off limits, and how to properly manage that once you get that lump sum. Um, a big windfall may be difficult for people to manage, and even though you're better off, someone may struggle with getting all that money at once.
Oh, they definitely will. They definitely. That's why lottery winners and people who sign huge contracts in sports, especially who are young, who didn't have who have money, and probably got maybe they get bad advice, maybe they don't listen to it. Who knows? But yeah, lottery winners. There's a pretty high percentage that wind up bankrupt again.
I think you almost have to approach it at that point like an RMD, and like you have to at least take out something at some point. But yeah, I think you guys nailed it. There's a lot of people that get handed a lot of money and find a way to blow it very quickly.
Well, you could use the okay. You can take out 5% a year. You can take out, and I don't know if it passes to the heirs like Social Security doesn't. Once that's you take it at 67 in one day, you kick the bucket. It's like, oof, yeah, you didn't get the benefit of saving all that money. So no, you probably do have to have some controls on it, but I just feel like it would be a lot more. We'll see.
Absolutely. But the point I was trying to make with that, I appreciate all your guys' follow up to
You didn't
that.
expect me to answer this, did you? Or
No,
Mike?
no, but it's like it's inflows, and I just me, I love flows. I'm a huge
Hmm.
fan of it, and it really is the driving force, right? Whether it's majority buyer, majority seller, but people wonder like why is the market so resilient, and what's different about the market now versus 10, 20 years ago. Flows like this didn't necessarily exist, so I bet they continue to come up with ways to continue getting consistent flows in the market. And as long as everybody's smart, hangs on for the long run, invests, not day trading zero DTE options like myself, I think they'll be fine.
Yeah. By the way, we're 2.76% off the all time high.
Yeah, we're right there.
I don't think the the sentiment is matching where we are.
It's weird. It's like again the most hated rally, Mike. Right?
Is that because you think there's investors that expect us to continue to make all-time highs, or is it there are investors who can't believe we're even this high,
I
or is
I
it a
think it's
combination?
no, I think it's the latter. I think
Yeah.
there's yeah, and even when it's been this good, really since the bottom in April, it's been so good. Any little pullback, it's like oh my god, a 1.5% down day feels like a 20% down day. It's like wait a second, why is this red? Why is my screen red? Why am I so? No, I think there is a mismatch, and going into the end of the year, these are particularly normally some of the best months. I mean, who knows? We'll let you know when we know. That's why we generally advocate for being in the markets, but staying hedged, being buffered. I mean, that's kind of the core thing we do. But I don't know. And then the other thing I somebody asked me today. So we had done a webcast for an advisor where we had some data on presidential elections and what the markets do. And somebody was asking me what the markets do during the midterm year. So I'll have to start pulling that data. I can't remember if it was good or not. I feel like it was historically, but we'll definitely do that research. Somebody asked me about that. So yeah, Mike. I mean, don't you think like there's a mismatch here?
Yeah. Yeah, absolutely. I think there's still people that are surprised that we are where we are, and just being a couple percent off the highs, it feels like a lot bigger deal. And maybe that's just because I'm staring at numbers and charts all day, but it feels like a lot bigger deal than it actually is. This is just a normal, healthy, small sell off in the grand scheme of things.
I will say that I think some of the Bitcoin crowd is disappointed. It hasn't held. Kind of 100,000 was the line in the sand. Did it cut? Did it break that today? I think it broke
Yes.
it. Yeah, I didn't see where it closed, but You look at MicroStrategies, they were down, what, 4.22%. IBIT is kind of the one that we watch from an ETF perspective because they hold, it's down 3.8% today. So people are, talked about flows. The flows are coming out. I saw something on Bloomberg, an article, might have been Bloomberg or CNBC, but people are selling their Bitcoin ETFs. So more sellers than buyers. That's kind of what happens. So
I don't know what exactly strategy did in the late 90s, early 2000s. I need to probably read more into that.
not holding Bitcoin.
What I do know though is that strategy in 2000 topped at $333 and bottomed at 9 in the same year. So it'd be pretty ironic if this thing falls apart a second time on Saylor. We'll see.
Yeah, I mean, this is totally different. I mean, that was just their MicroStrategies business back in 2000. I'll have to look. I don't remember that, so I'll have to look into that.
I wonder if this is due to a lack of follow through from the current administration here in the government. I think the market was really expecting. It's been like 9 months, right, since inauguration, and we haven't really seen much involvement in the Bitcoin or crypto space.
They haven't gotten in the way though.
No, they've been very friendly with respect to taxes, I think. But it's interesting to say the least.
I mean, here's the thing: when part of the Bitcoin crowd, I'm going to get emails about this. You can send them to derek.moore@zegainvestments.com, derek.moore at Z as in zebra, E as in Eddie, G as in George, A as in Apple. You got to figure out how to spell investments on your own if you want to. But I'll get emails on this. Part of what that crowd does is I think they're always trying to talk other people in, whether it's companies, governments, to use Bitcoin, because you need the marginal buyer, that next buyer, to help keep it up and help keep it rising. You need more buyers and sellers. Goes back to flows. So, I mean, in one hand, having a Bitcoin ETF, which is helping the price of Bitcoin because they have to hold Bitcoin, or maybe synthetically they do, and then there's hedging and whatever. I think they helped, but they can also hurt because it's very easy for somebody who is just a normal investor to say, I don't like that this has gone down so much. I don't like the volatility. I'm just going to liquidate the ETF and I'll move on to something else. So
You can, and it can be shorted too.
and it can be, it can be shorted. So I'll do more. Well, where's my thing? I was going to do this. I'll do it real quick. The thing with strategy, which is strategy, they renamed it. I always kind of think about sometimes people overcomplicate what he's trying to explain they're doing. I mean, in the end, they're issuing preferred shares, which is quasi debt because they're paying interest on those. Some of them pretty high on the coupons. They're issuing bonds, and a lot of those are convertible at some price. They have put options or put features on them too, where, and I don't know the exact terms, but the investors can put back the bonds at certain dates to the company. I believe it's at par or some other value. And, they talk about Bitcoin yield, which is the difference between you take the Bitcoin per share ratio in one period and the Bitcoin per share on the next period. And the yield is the difference between those two. And it's positive if your Bitcoin per share went up. They talk about amplification, all these things. But it got me thinking, I mean, what if they, instead of buying Bitcoin, they were just buying Apple shares? And, the people will be like, Derek, you really can't do that because Bitcoin's a finite asset, meaning none can ever be issued again. Once the supply is done, it's done. Okay. I'll take that at face value. I mean, people have told me they can fork it, they can do other things. I have no idea. So I was thinking about Apple, and I looked at Apple in December 2006, which was the end. I think that was their fiscal year end back then. And there were 24 billion shares outstanding. Today, after buybacks, there were 14.7 billion. And they bring that up because sometimes I think the Bitcoin confuses how people are looking at this company. In the end, like if you're a company, you could buy Apple and you could say, well, I'm going to take leverage to buy Apple. I'm going to issue preferreds. I'm going to issue debt. I'm going to issue more shares. And of course, but in theory, although Apple doesn't have a finite supply, they've actually reduced their share count because they've been doing so many buybacks. So, I mean, Mike, am I crazy just to think about, like, to me, when I try and explain this to people, I use something else to simplify it because Bitcoin seems to cloud the discussion. Am I wrong to say, like, if you're buying Bitcoin, why can't you buy Nvidia? Why can't you buy Apple or buy whatever?
Yeah. I mean, maybe I'm missing something, and we talked about this the other day, but it seems to me like it's a leveraged Bitcoin play. I mean, is there any other scenario where this company, this stock price goes up without Bitcoin going up? I mean, it's completely tied and relying on the performance of another asset that they're purchasing. So I think it's a very fair comparison.
And I mean, there's cost to run the company. Like an investor today could buy IBIT, or it doesn't have to be IBIT, but could be one of the Bitcoin ETFs. I mentioned IBIT because that closely follows the price of Bitcoin. Some of them are different, but you could buy that. You could buy Bitcoin if you were so inclined. I mean, that's up to you. But by buying strategy, you also take on the debt. You're also responsible for the debt. They are issuing more shares, which in theory dilutes the existing shareholder base. And the company, there's some cost to run the company. There's employees of the company. I don't know what Michael Saylor's compensation package is. I'm going to get emails even talking about this, but I just, I don't know. Shane, like, why not buy Exxon stock?
Well, I'm gonna, I again, I'm convinced that if they can find a way to maybe unravel some of the Bitcoin exposure and shift it into a tech or an AI move, then maybe there's something there. But I agree, it's really no different than a leveraged stock play. It's just on a different asset type. I think a lot of people have figured out that what's really the point of owning this when I could just buy the other thing directly. Um, and it, I don't know. In my entire life, like I haven't seen every leverage play, blow up, but it seems like those are the ones that usually see problems down the road. I don't know exactly what price Bitcoin has to get to before they're in significant trouble, but the fact that we're back below 100,000 and just psychologically such a huge level, um, it's a bit concerning. And what was, I think, the last big blow up in the leverage space that I remember was it Bill Hwang. Um, what was the name of that firm that he ran?
Yeah, I know what you're talking about. It does. I don't remember the details
The
now.
Archegos, yeah, Archegos Capital Management. Um, I think there's the history in the market is riddled with over leveraged positions or strategies eventually blowing up. Um, this could catch and rally and go right back up, but we'll see.
Yeah, I don't look. I don't think the leverage is crazy in there. I don't think it's crazy.
No,
Maybe
there's a
I don't
lot of
know. I mean,
leverage
it's
in a lot of positions and strategies out there. Leverage is a huge
but the thing that
tool.
Chanos did was Jim Chanos is he said, I'm going to short MicroStrategies. I'm going to buy Bitcoin. He's like, I like the asset, but when you buy, and this is back then, when you buy MicroStrategies, I think at the time it was like 2.3, its enterprise value was 2.3 times the value of their Bitcoin. And enterprise value is the outstanding, so the common shares, the preferreds, and then the debt. And he's like, look, even if he only loses money on that trade if MicroStrategy's premium to Bitcoin goes up, not down. In fact, it's like 1.19 or 1.2 times the enterprise value. So I don't know. We'll see how this works out. But I guess the point of me bringing this up is, excuse me, sometimes Bitcoin, just this idea of what Bitcoin is and what it, and all these different ratios, I think sometimes it confuses people. And I'm just going to tell people, like, when you're looking at this stuff, just be careful. And I'll let you know in a couple of years how this works out. So I don't know that Bitcoin going down necessarily hurts them or doesn't hurt them. They do have the interest on the debt. So if you pay the interest on the debt, you could sell assets that you have. If they don't want to sell the Bitcoin, they could issue more shares, which of course would dilute the existing shareholder base. They could issue more debt to pay the interest. So, all right, we done with this? Can we be done? I'm already going to get emails
I'm
on this.
good.
Let's
Okay.
do it.
Let's do any recommendations this week. Shane, to you first. You can give like one, maybe 1.5.
Oh, I've got mine ready. I've had it ready.
Okay, what do you got?
Huge Stanley Kubrick fan. We're talking AI. 2001: A Space Odyssey. If you haven't seen it in a while, I assume most people listening have probably seen it. If you haven't, please do. If you haven't seen it in a while, go back and rewatch it. Such a great movie.
Did you watch Good Will Hunting yet? You'd never seen that.
No, it's still on the list. We might catch some time to watch it this weekend, but we've got playoff football. We're gonna go watch my dad coach in, so we'll be with family. I don't know if we'll be able to sneak it in this weekend, but it's still on the list.
Okay. Mike, you want me to go first or you want to go?
I can go.
Yeah, go for it.
So All Her Fault. Ended up watching that. Mentioned I was initiating coverage last week.
Yeah, that's a big move by you. Yep.
Yeah. It's a buy. It's
okay.
good.
Oh, okay.
Yeah, it's very good. It's about a missing child and this family and the drama amongst the family while they're trying to figure this all out. Takes place in the Chicago area. So yeah, it was it scared me a little, but it was good. I recommend it.
Yeah, those are different when you have kids versus not having kids. I'll leave it at that, right?
Yeah.
It's like my wife watched it. She thought it was good. But one of the cast members played Shiv in
Right.
Succession. And she was great in Succession. So I walked by at one point and I'm like, oh, there's Shiv. So it's tough to unsee people in a show that was just, if you haven't seen Succession yet, like get on it immediately, right? So, all right. So strong buy, or is this a
just buy.
okay?
Yeah.
All right. Mine. It's funny you mentioned that because the character from Succession's in there. I watched Death by Lightning on Netflix, and it's like I think it was 4 episodes, limited series. So I like those. I like movies, I like limited series because, I'm done. Like I watch it and I'm done. It's about the assassination of President Garfield, who was only in office for 3 months. But Tom from Succession was one of the characters. So I'm initiating coverage on this one. I'll give it a buy rating as well. And one of the things I don't want to, I'm not going to ruin it for everybody. It was just fascinating to see how they chose who was going to run for office by each party back in, the late 1800s. Like these guys just show up by horse and, whatever, just kicking it by themselves, just walking in. So there you go. All right. I think we solved all the problems in the world. We good?
Great.
All right. So next week, is it the 19th is what, Wednesday? Is that
Yes.
Nvidia earnings?
That's right.
All right. So and then, I keep saying, like last week, we're like, oh, we'll let you know next week. And I never remember what we said we were going to come back to, because other stuff happens, and that's what happens in the markets. There's always something going on. All right, Mike, Shane, good work as always. For everyone else, we'll talk to you next week, and we'll see what happens with Nvidia. See you, everyone.